Welcome to the Candlestick Forum Training CD program. This training CD will expose insights into how to use candlestick analysis successfully. The information provided on this CD is not newly found trading techniques. The information conveyed is the product of approximately 400 years of successful utilization of candlestick analysis. The Candlestick Forum, found at www.candlestickforum.com, is one of the leading internet websites for teaching investors how to use candlestick signals successfully. There are over 400 pages of information on the website that provide educational insights into using candlestick signals successfully. Candlestick analysis is not a complicated process. As will be found in this training CD and throughout all candlestick analysis, the principles of the signals incorporate common sense investment practices. Continuous education can be found in the forum, on the live chat room, and on the Monday night and Thursday night training sessions on the website. Whether a stock trader, a commodities trader, or a Forex trader, the Candlestick Forum website can provide valuable information for improving your investment techniques. This training CD will explain the common sense logic provided with the candlestick signals stop loss technique. The candlestick signals work off very simple premises. They illustrate when it is time to buy and when it is time to sell. Not all trades are successful. Candlestick signals provide the ability for an investor to quickly liquidate investment trades that are not performing correctly. A candlestick buy signal in its proper location of a trend does not necessarily mean it's going to work successfully. Although the probabilities are greatly in the investor's favor when witnessing a candlestick buy signal at the proper position of the trend, that does not guarantee that the trade is going to be successful. The important word of this previous statement is probabilities. Seeing a candlestick buy signal in an oversold condition produces a high probability of being in a successful trade. If that probability is 65%, 75%, or 85%, that still means there is a percentage probability that the trade will not work. The point of investing is to maximize your profits and putting the probabilities in your favor. The often heard sage advice from the so-called professionals is cut your losses short and let your profits run. Well, after being in the business for 30 years, I have yet to hear how these professionals want you to cut your losses short and let your profits run. The benefit to candlestick analysis is that there is very clear and simple levels of trading in a trend that tell you whether you should be in that trend or not be in that trend. That makes establishing stop-loss procedures very simple. Many investment advisors also advise that you should take your losses at 3%, or 6%, or 8%, or 10%, or whatever arbitrary number seems to be their liking. The point of investing is that if you're buying a price move, the markets do not care where you bought and they don't care where you get out. An uptrend can have all sorts of price changes, but if it doesn't change the investor sentiment of that trend, continue to hold. What is the purpose of a stop loss? That may seem like a relatively simple question. Most people are going to answer that a stop loss is used to minimize losses when prices move against you. And that is the correct answer. What most investors fear most is stepping away for lunch and coming back and seeing a price action something like this in one of their positions. Utilizing stop losses effectively eliminates the fear of experiencing big losses. But more importantly, being stopped out of a position immediately frees up capital from a bad trade and makes it available to recommit in a better probability trade. This may also sound simplistic, but have you ever watched a position move back through an area that you knew was the place to be out of the trade, and you were kicking yourself 3 days later that you were still in the position? Not only were you losing money in the position, but you wished you had taken that capital and made it available for another trade that had looked extremely good. But you were hoping for this trade that you were still in to go back in the direction that you thought it should. Having a preset level that was analyzed as being the spot to be out of a trade based upon what the candlestick signals were telling you eliminates having to make that emotional decision. The price has fallen so fast, I should wait for a bounce. I hate to sell at the bottom. This price was already oversold when I first bought it. Many reasons can be conjured up in the mind for not closing the position when it has gone the wrong way. Candlestick analysis eliminates having to make those decisions. This leads to the most important factor for using stop losses. That is keeping the mental thought process clear. Just as any other business decision requires, having a clear mental thought process is needed for successful investing. Establishing a simple, common-sense stop-loss procedure utilizing candlestick analysis keeps your investment psyche fresh and clear. This is the most important aspect of the purpose of a stop-loss. Having the mind clouded by a trade that is not working as it should, and you realizing that it should have been closed out at a level that was obviously not at this level, does not allow the investor to think as clearly as they should about their existing positions or establishing new positions. Candlestick analysis stop-loss procedures work based upon one very simple premise. What is the logical price level that would indicate that the bears were still in control of a trend after the initial buy signal? Or where is the logical price level that the bulls are still in control of a trend after the initial sell signal? This is very simple logic. It does not require calculations. It does not require percentage change. It is a very simple visual analysis of where the trend was not working or has reversed from the direction that you were in that position. Let's do a quick review of the candlestick signal basics. The difference in candlestick signals versus bar charts was the Japanese application of taking the open and the close and boxing it in. A white candle is formed when an open is followed by a close that is higher than the open. This becomes the real body. The trading below the body is called the lower shadow. The trading above the body is the upper shadow. Conversely, an open that is followed by a close lower than the open creates a black body. Again, the upper shadow and the lower shadow. This may be review for most people, but it's a reminder that the psychology that is built into the signals is very important, and that will have some very strong applications for producing stop-loss procedures. This training CD will show you how to use effective candlestick stop-losses when you're establishing a new position, when you're maintaining a position in a trend, and when it's time to take profits. Knowing the psychology that the Japanese rice traders utilize for identifying candlestick reversal signals becomes a very important factor for establishing stop losses. What would indicate a buy signal failure? If you understand the criteria that formed a candlestick buy signal, the placement of a stop loss becomes very simple. The bullish engulfing signal illustrates a dramatic change of investor sentiment. The bulls have now taken over control, reversing the prevailing sentiment of the previous trend. The bullish engulfing signal illustrates that the bulls should now be in control. What would indicate that that would not be true? If the bears could close the price more than halfway down into the candle that told us the bears were in control. Logic dictates that if the bears could negate more than 50% of that signal, then the bears were still in control. Number 2 is the only formula needed for understanding much of candlestick analysis. As taught in our 12 Major Signals Training CD package, 2 is an important investment factor for the Japanese rice traders. The hammer and the hanging man should have a lower shadow at least 2 times greater than the body. The shooting star and the inverted hammer should have an upper shadow at least 2 times greater than the body. Prices closing more than one halfway down, a bullish signal illustrates that the bears are still in control. The opposite is true for a sell signal. If prices can close more than halfway up a newly established sell signal, that indicates that the bulls are still in control. As taught in our Bullish Hiromi training CD, what is expected the following day to confirm a bullish Hiromi? That the buyers are still in control. Or, on a small body signal, such as this bearish Hiromi at the top, the body may become less important, but the level that would indicate that the bearish signal had been negated becomes the logical stop-loss area. The rationale being that a bearish Hiromi indicates that the buying had stopped. If the prices opened lower the next day, establishing a short position, and the prices could not stay down and moved up above that level, that would still be an indication that that signal did not work and you should be out of the position. The signals that are created by a longer body, such as the bearish engulfing signal at the top, just like the bullish engulfing signal at the bottom, has 2 points of logical stop losses. What does the bearish engulfing signal reveal? That the bears are now taking control. But a close above the halfway point of that bearish candle would indicate that the bulls are still controlling the trend. Any trading during the day above the top of that candle would clearly indicate that the bulls are still in this trend. If prices opened lower, confirming the bearish engulfing signal, prices should not come back up through the point that told us the bears were now taking control of the trend. A stop loss can be put on at that level immediately upon executing a short position. The piercing signal at the bottom, usually created by a long-bodied candle, also has 2 logical stop-loss points. Prices should not close more than halfway down that candle if it was bought on confirmation that day. And prices should not come back down through the open of that signal anytime during the day. That would indicate that the bears are still in control. And the counterpart of the piercing signal, the dark cloud, would obviously have the same parameters. If it confirmed by opening lower the next day, you would not want to see the prices close above the halfway point, and you wouldn't want to see any trading above where the sell signals started its downtrend. The morning star signal is also an example of a large body candle that would use the halfway point as your stop. A positive open should not see a close more than halfway down that candle and should not see any trading below the beginning of that bullish formation. And obviously the parameters are the exact same for the evening star signal at the top. A lower open should not see a close above the halfway point of the candle that confirmed the evening star signal, and we shouldn't see any trading above the point that told us that the evening star signal will start to show a downtrend in progress. The hanging man signal, also one that if it gets confirmed by opening lower, it should not close above what was the indication that the sellers were now starting to take control. The shooting star, also a small body signal, would tell us that once we saw the shooting star and the next day it confirmed by opening lower, we should not see a close above the level of that body that told us that the sellers were starting to take control. These are just common sense points that would tell us that the selling has not started in this downtrend. And the same would be true for the inverted hammer at the bottom of a trend. Once the inverted hammer is formed, what do we expect to see? A positive open to confirm the inverted hammer. What we don't want to see is any trading back down below the bottom of that signal, which is where the bulls started to show us they were taking control. A price move below that level becomes your immediate stop loss point. It tells you to get out of the trade that is not working. As you proceed through the following demonstration charts, let your eyes recognize where the logical points are that would indicate that the sellers were in control or the buyers were in control, and that you want to be out of that trade as quick as possible. This becomes a very simple procedure for setting your stop losses at levels that can obviously be seen that are negating the signals in a price trend. Stop losses should be placed at technical levels that are obviously being watched by other technical investors. Trend lines are the most commonly used support and resistance levels. A trend line can be drawn through recent bottoms, producing a support level. Drawing a trend line through recent tops produces a resistance level. Trend lines can be produced for any time frame, a 1-minute chart, hourly chart, daily, weekly, or monthly chart. Any trend line that can be drawn through obvious tops or bottoms are going to be anticipated as support or resistance by a certain number of investors. The advantage that candlestick signals provide is being able to see what the investor sentiment is doing at those levels. It does not require any great technical analysis to see where a support is on a chart. Draw a horizontal line where the stock price often trades down to and then bounces back off. This line reflects the investor sentiment. Their memory of lost opportunity is what supports the stock from falling any further. Placing your stock slightly below that level keeps you from getting stopped out at that bounce. If the stock breaks down below that support level, it suggests the investor sentiment has changed and it is time to exit your position. This is reinforced by what your signals are showing at that support level. If you do not see any bullish candlestick potential and it goes through that trend line, it is obvious that that investor sentiment has not shown any buying at that level. The trend line is not acting as support anymore. When evaluating a potential reversal, the charts can usually be analyzed for projecting the upward target. The Activision Inc. chart revealed a bullish Hiromi with stochastics in the oversold area. What becomes the probable results? Testing the 50-day moving average, which would coincide with the most recent peak in prices. What level would tell us that the uptrend had failed? If it came back down through the level that told us the buyers were taking control, the bottom of the bullish Hiromi. At that point, that becomes your stop loss. That would show that there was no confirmation in the reversal signal. If a candlestick buy signal is an indication that the buyers should be stepping in, the longer the buy-in does not appear, the more critical the halfway point of the bullish buy signal becomes. As seen in the American Celluloid Company chart, the bullish Hiromi followed by a gap up became a very strong buy signal. The next day didn't show any great strength, nor did it show any great weakness. A close below the halfway point of the bullish Hiromi signal now becomes the logical stop loss level. The next 2 days of trading after that also reveal indecisive trading. The third day showed the price actually came down through the halfway point, but closed as a doji, not doing any harm in the uptrend. The fourth day also showed indecisive trading as a spinning top. However, we have been expecting buying ever since the strong buy signal. At this point, it would now be logical that if the prices came back down through the halfway point of that bullish candle, the bullish Hiromi signal, that would indicate that the buyers were not there. It would be time to use any trading below that signal as your stop loss. A few days after a trade, a close below the halfway point is your logical stop loss. Getting on beyond that, any trading below the halfway point of that level or of that bullish signal becomes your obvious stop loss level. Candlestick signals provide valuable information at important technical levels. The major moving averages are watched by the majority of professional money managers around the world. You will find in these illustrations that the inclusion of the important moving averages will be on all the charts. The red moving average is your 200-day moving average. The blue moving average is your 50-day moving average, which we consider the major moving averages. We also have included the 20-day moving average, which becomes important when trends in stocks or market indexes can occur for an extended period of time. The major advantage of candlestick signals is that they illustrate what is going on in investor sentiment. Isn't it the deep-rooted hope of all investors to do their analysis of what they expect to be a positive trade, but in the back of their minds hoping that this particular trade could be the home run? Fortunately, the information incorporated into candlestick signals at least puts the investor in situations where they could potentially turn out to be that home run. Being able to participate in big profit moves has two great side effects. First, the benefit of greatly increasing the value of the portfolio. Secondly, that inherent boost to our egos. There is nothing more satisfying to our egos than being able to analyze and executing a big profit trade. Unfortunately, it is the human ego that is usually the downfall of most investors. When analyzing what would make a good buy signal, also analyze what would be the area to be out of a position. Notice in the TFSM chart that we've started seeing some dojis occurring in the oversold condition. What would be the confirmation that it was time to start buying? Positive trading. What would also be a good area to tell us that we should not be in this position anymore? What could be logically seen as support in the recent trading? As we saw over the next couple of days, the buying did come in, may have gotten us into the position, but the selling came right back in and should have had us out of this position. Now, does that mean we give up on this trade? Definitely not. The reason we bought this position in the first place was we were starting to see candlestick buy signals in an oversold condition. Even though the trade did not work initially, we're still in the oversold condition. We should still watch for the next buy signals. But the same analysis occurs. What do we want to see occurring after a potential candlestick buy signal? We want to see buying coming into the position. Now what becomes our criteria for owning this position? We should see it moving up. Where would be a logical spot to tell us that the buyers weren't in control? Probably a close or any trading below the halfway point of the bullish candle that told us it was time to get in. Once we saw that, we should have utilized our stop loss to be back out of this position because it did not do what we had expected it to do after a candlestick buy signal. After a candlestick buy signal is revealed, closing below the halfway point on either the first day, the second day, or the third day does not matter. It still reveals that that trade did not work. The bears are still in control. The same analysis can be applied to the Advanced Energy Industries chart. A doji forming at the oversold condition, followed by a strong open the next day, would have been a logical buy scenario. The close right at the 20-day moving average should have provided some expectations for the next day. To continue the uptrend, the 20-day moving average should have been breached relatively early in the trading day, indicating that the buyers were still there. The fact that they opened it right at the 20-day moving average and started trading it down started to make the halfway point of the previous candle your obvious important stop level. The question often arises whether the stop should have been during the day or on the close. In a case where the stochastics are in the oversold area, it is not unusual to see some residue selling after the initial buy signal. However, a large percentage of the time, the price will pull back, sopping up that residue selling, and eventually closing up near the top end of the trading range. As seen in this chart, though, the price closed more than halfway down the candle. That is not the immediate sign that we're looking for that the bulls were in control. Could the 200-day moving average act as support? Obviously it could, but why chance it? Come out of the position and wait to see what it does at that level. If it does a doji, a hammer, or any other bullish candlestick signal the following day, you can always buy back the position. Understanding what each candlestick signal illustrates as far as investor sentiment allows for the anticipation of where the correct reversal move should go. Very simply stated, upon seeing a candlestick signal, there should be the expectation of a bullish candle the next day. A close below the body of a hammer signal would not confirm new buying. That becomes your stop loss criteria. When do you start looking for a candlestick buy signal? When prices gap down in the oversold condition. As illustrated in the Amdex Limited chart, a hammer signal formed after a gap down at the bottom of a trend. The stochastics were in a relatively oversold condition. Relatively. But the hammer signal, at the same level it supported before, becomes a very strong buy scenario. The next day, as the price opens higher, this becomes an excellent point to start buying. As the price moves up that day as expected, where do we start anticipating putting a stop loss? Where would be the price level that would indicate that the sellers are still in control? At one tick below where they created the buy signal, the hammer formation. This is a clear indication that if the prices came back down through that level, that the bullish buying force had disappeared and you want to be right back out of the trade. Use the level that becomes most logical as a point where the sellers have taken control. As illustrated in the Alex and Baldwin Incorporated chart, any buying on this signal produces the same stop loss execution levels that make sense. A close below the halfway point of the bullish engulfing signal is the first obvious stop loss level. The next level would be any trading below the open of that candle. The rationale would be that if the sellers could push the price back down through the previous day's open, the beginning of the bullish signal, that would be a fairly clear indication that the bulls were not in control of this trend. This would be the time to get out of the position completely, even if it's during the day. As can be seen, the following day consolidated but closed near the top end of the trading range. Again, not unusual to see some residue selling at the end of a downtrend. But what should be expected the following day is something to confirm the buy signal, which would be the anticipation of further buying. Putting a stop at the previous day's low, which kind of coincides with the halfway point of the bullish candle, is the next spot to be considered for your stop loss. Number one, the probabilities say we should be going higher. Number two, we shouldn't be trading back below this level if we are confirming a buy signal. The strength of a trend will usually be revealed within the first few days of how that reversal has reacted to the buy signal. The point of investing is to put the probabilities in your favor by analyzing the candlestick reversal signals. The Southern Copper Corporation chart reveals an excellent buy signal. Two dojis in the oversold area right at the 200-day moving average. The enthusiastic buying the next day makes this a very strong, profitable potential trade. However, we see the same type of trading pattern that we just saw in the Alexander and Baldwin chart. A day of consolidation followed by a selling day, closing more than halfway down that previous candle, the previous bullish candle. The probabilities say close out the position. Was this a bounce in a downtrend? Could the following day take prices down to new lows? That we do not know. What we can observe is that it does not look like this is a strong position to be in right now. This position should have been stopped out with a close more than halfway down the candle that told us that the bulls were taking control. What can be analyzed from this point? Obviously, the 200-day moving average could be a factor. Until we get more information, this trade currently does not look enticing. The next day forms a bullish Hiromi, followed by confirmation buying. Now this analysis becomes much more clear that the 200-day moving average may still be acting as support. Also, it might be revealing that this downtrend, instead of having one day of consolidation, may need 2 or 3 days of consolidation. A stop loss gets you out of a trade when it doesn't appear to be working. That is the exact reason for utilizing candlestick signals. There is nothing wrong with buying a position when it looks like it's time to buy and getting stopped out when it looks like it's time to be out. There's nothing wrong either with buying back the position when the signals start confirming that it's time to be back in this trade. Getting out at the right time is just the cost of doing business to protect yourself from big losses. Utilizing stop-loss levels with candlestick formations anywhere in a trend uses a very simple approach. Where would be the level that would reveal that the sellers have taken control of the trend? As prices start moving up out of the oversold area, the halfway point of the previous bullish candle becomes less important as the stochastics indicate an uptrend in progress. Now what becomes the logical level? The open of the previous day's bullish candle, provided it is a long candle, not an indecisive trading day. As can be seen here in the Avco Inc. chart, the uptrend appears to be in progress. Maybe the 20-day moving average could act as resistance, but it appears as if the stochastics have enough juice in them to take it all the way up to the 50-day moving average. So with the uptrend appearing to be in progress, what becomes the logical that would indicate the sellers are in control? Any trading back below the last large bullish candle. That would indicate the bulls do not have the force that they had starting this uptrend. Close out the position. The sellers should not be this strong during an uptrend. The same situation can be seen in the Agilent Technologies chart. The indecisive trading, followed by a bullish engulfing signal, revealed that the uptrend was starting, the stochastics confirming. If the bulls were in control of this trend, they should not see any trading back down below the previous day's open. It should have opened near the high end of the range and traded higher, with maybe some backing and filling. The fact that they opened it lower and immediately started taking it back down through the previous day's open, and especially the 3 previous days' close, clearly reveals that the buying pressure is now gone from this uptrend. Close out the position as fast as possible. Or have your stop loss placed at the previous day's open or at the previous day's low if you are not able to watch the screens. Indecision in an oversold condition could usually be the prelude to a strong uptrend. As illustrated in the Alvarian Limited chart, the flat, indecisive trading candles, the dojis, the spinning tops, could be the indication that a cradle pattern may be forming. Over the next couple of days, the positive opens would be a good indication that a strong uptrend should be ready to start. What is expected after seeing indecisive trading at the bottom of the trend? Potentially a very strong uptrend. Position was purchased on these positive trading days. What becomes a logical target? The 50-day moving average, which would correspond with the last little peak that was in this price trend. What becomes the obvious stop loss level? Right here. If the prices came back down through that level, that would tell us that the sellers were still in control and that the buyers were not there. The fact that it came down this day, you should have stopped out at this level because that would have been the indication that there was no buying strength. If you held on to it through this day, what should be expected the next day to continue the uptrend? Positive trading. The fact that they bring it right back down through that level again should have been a clear indication that this was your stop level. One of the biggest problems most investors encounter is figuring out when to take profits. The same dynamics work against investors for taking profits as they do for trying to buy at the bottom. Emotions. Just as it is difficult to start buying at the bottom when nothing is indicating that there is any reason to buy, that is when the fight against fear has to be overcome. Fortunately, the candlestick buy signals become the format to indicate when that investor sentiment is changing. Conversely, the opposite emotion makes it difficult to decide when to take profits. When do people sell? They panic sell at the bottom. When do people buy? They buy exuberantly at the top. This knowledge can easily be incorporated for taking profits at the appropriate times. Placing stop-loss executions at the appropriate levels allows the candlestick investor to extract the majority of the profits that will be coming in and out of a trade. One of the facets of exuberant buying at the top is the gap up in the overbought condition. Being able to identify the potential of a candlestick sell signal formation produces some very simple stop-loss procedures upon seeing that gap up at the top. What is every investor's great hope? Getting into a trade or an investment that after all their reasonable analysis for that profitable trade, that they have finally hit a trade situation that has produced the home run. The big, huge profits finally coming from taking the risk and participating in a price move much bigger than ever expected. The exhilaration of seeing a price gap up one morning when you wake up just kicks the emotions into overdrive. Oh boy, have finally gotten into a trade that is going to go through the roof. But unfortunately, there is reality. As illustrated in the Equity Inns Incorporated chart, that exuberant feeling would have been experienced on the huge gap up from the following day, or the previous day. Even the toughest and most experienced investors will have that twinge of exhilaration thinking that they finally hit the long ball. The candlestick buy signal, the cradle pattern forming in the oversold condition, was the right analysis for anticipating an up move. What would have been the first resistance? The 50-day moving average. Then it pulled back to the 20-day moving average and didn't show any great selling. Comes up through the 50-day moving average, and what's the first thing it should do is come back and test it. The next day, they take it back up. This would indicate that now there's a possibility they could at least pop it back up and test the recent highs. However, your stochastics are in the overbought condition, starting to head down. What should be the analysis the next day when they open it higher? Of course, that exhilaration will kick in. The first thing to do, if it opens higher and starts moving up, put your stop loss at where it opened. If it opens higher and immediately starts trading off, put your stop loss at where it closed the night before. The rationale for this decision is if it opens here and starts moving up, and before the end of the day they've brought it back down through the open, more than likely you're going to have a candlestick sell signal form. Additionally, if they open it here and immediately start taking it down and it comes down through the previous day's close, again, you're going to have a candlestick sell signal form. This stop loss procedure becomes very effective in those price moves that seem to go on forever. As illustrated in the ERS chart, the price moved from the $7 range up to the $60 area in approximately 5 months. On these type of chart moves, knowing what to look for the exuberant buying at the top makes stop loss procedures very easy to implement. As we can see, as this price started moving up, we started seeing gap ups in price up in the overbought area. Here's a case where it opened higher and came back down. So somewhere during the day you might have taken off part of your position, or at least half the position, at this level. This would be a case where if you know your strong uptrend is going or is moving, once you start seeing the gap ups, you start taking profits and maybe keep on the other half of the position. The next day they gapped it up again and took it up. Again, this becomes another place to take maybe half your position off and find another spot that would indicate that the selling was getting stronger and take the other half of position off. Here would have been the second case, to take off some more of your position as it opened and headed up after gapping up the second time, and if it came back down through that level, take some more off, and once it came back down through this level, at this point it becomes obvious that the sellers are now starting to take control. You want to be out. Even if they brought it back up, you're probably going to have a spinning top or some other candlestick sell signal at these levels. And as can be illustrated in the Infosonics Corporation chart. Had a nice fry pan bottom that formed a very strong uptrend. Notice the gap started the breakout of this uptrend, and they started gapping it up in the overbought area, showing exuberant buying. Here would have been a case that if it opened here and they started taking it up, you put your stop loss here. If they had opened it here, you put and started bringing it back down, you put your stop loss at this level. The next day, as they gapped it up, first spot to put you, and start immediately backing it off, take off some of the position here, and if they came back down through this level, take the rest of the position off. Again, this is nothing more than common sense that tells you when they start exuberantly buying at the top, and you start seeing the prices gap up every day, you're getting close to the area where the candlestick sell signals will start forming. Pick the logical spots that tell you it's time to take profits. A gap up in an overbought condition or near the overbought condition, but gapping up through a previous resistance level may be the opportunity to start seeing a breakout situation. However, if it opened here and started moving back up, again, the same logic. Put your stop at the open that day. If it comes back down through that level and comes back up and closes, of course, we've got a doji. And that does not signify any positive trading in the overbought area. That was where you probably should have started coming out of your position. Strong buying followed by a gap up should be the first sign, especially the gap up, that you want to at least start watching for a candlestick sell signal. Once again, an open at this price and starting to move up makes it logical to put a stop loss at where it opened. Second spot would be at the previous day's close. In this case, no matter how far it went up and how far it came down, that gap up told us we start watching for a candlestick sell signal. If it opened here and came back down, it's going to form a doji, a bearish engulfing signal, a dark cloud, a hanging man. Anything in the oversold bought area, and you start seeing the potential of a sell signal, which is initiated by that gap up in price, put your stop losses at the logical spots. Illustrated in the Blunt Incorporated chart is a nice strong up move, and notice they gapped it up right at the 200-day moving average. At this point, when they started selling it off, it now becomes logical that if your stochastics are in the overbought area and they've opened it right on a major resistance level, you might want to take your immediate profits. You might take off half the position there. Maybe it's coming back and ready to shoot through. But the probabilities tell us right now in the overbought condition with a gap up that we should be taking some profits. The next stop would have been right back down here, which it did come back down through. What is our biggest fear? We're always afraid that if we sell here, that it could go through the roof from there. But the probabilities tell us that the majority of the time when they gap up in an overbought condition, it's time to take profits. Taking half the position here and half the position here, you got your average cost here. Again, we're not trying to sell at the exact top. We're trying to take the fat part out of the middle. Again, when they moved it back up, notice how in an uptrend, they did an indecisive day and they gapped it up again. The logical spot, once they started bringing it back down, was to put your stop loss right here and, let's say, halfway down the previous day's candle, which would have given you the majority of this little quick move. This is nothing more than taking the probabilities and finding the spot that tells you that the candlestick sell signal may be in formation. In this case, a bearish engulfing signal. Seeing indecisive trading in the overbought area. Spinning top, hanging man, and then a gap up makes it that much more logical to put a stop loss back at a level that tells us that we've probably started to see the selling. Once again, when this price moves down, even if it moves up, it could produce a hanging man, a dragonfly doji. It could even move up and still produce a hanging man, spinning top, or a doji, or a dark cloud if it closes here, or a bearish engulfing signal. As illustrated in the British Petroleum chart, a gap up in the overbought area, selling back off, produced a dark cloud type signal. A gap up, stopped out at this level, going lower and coming higher. Some investors say, oh shoot, I didn't get to the top, but notice this hanging man signal illustrated we were probably very close to the top and they started selling it off. Whether you got out here or here doesn't make any difference as long as you got the fat part of the probabilities of being in the right position at the right time in this trade. The Cabot Corporation chart also illustrates that a gap up in the overbought area, immediately selling off, stopped out at this level, coming down and coming back up, still produces a hanging man signal. You got the majority of the profits out of this trade. Move on to a lower risk situation. Peabody Energy. also illustrates. Start seeing indecision and a gap up at the top. Logical spot, if it gaps up and moves higher, put your stop at this level. In this case, it produces a doji shooting star. Exactly what you want to see, that the indecision is now starting at this level. You got out at least half your position at that level, hopefully the other half somewhere in this range. You got the majority of the profits coming out of this trade. Very simple. A gap up, especially above a major moving average, and taking it back up, put your stop loss here, because if they bring it back down through candlestick sell signal, the shooting star has a good possibility of being formed. Anytime you see an overbought condition and you see them gap the price up, start watching for your candlestick sell signals. The point of investing is to have the probabilities in your favor. Hundreds of years of analysis by Japanese rice traders have produced common sense investment psychology built into graphic forms. Anytime you can analyze a situation where the probabilities have the potential of producing a candlestick formation that will be giving you valuable information, utilize the common sense practices that allows a candlestick investor to extract profits from the markets with a high degree of consistency. Will you occasionally miss a huge move after a gap up in an overbought condition? Occasionally. But those occasions will be so few and far between that to stay in positions where the probabilities are going against you will produce much more losses than you'll ever gain by hitting that 1% probability that you're going to be in a big move after a gap up. Anytime you see a situation where you're gapping up in an overbought condition, pick a spot that tells you where would be the logical place to take profits after you saw that gap up. The use of candlestick analysis can be used exactly the same for short sales. This also uses one basic premise. Where is the logical point that does not indicate that the bears are in control of the trend? Utilizing that analysis provides high probability stop loss levels. Just as candlestick buy signals at the bottom anticipate buying, a candlestick sell signal witnessed in the overbought conditions should be anticipating selling. Again, to reiterate, the hundreds of years of Japanese rice traders identifying and analyzing reversal signals indicate when these conditions occur. The probabilities are extremely high that the trend is over. The logical stop loss point becomes a close above where the signal was formed that informed us that the downtrend should be occurring. If prices open lower, confirming the sell signal, a close above the body of that signal, in the case of a doji, a shooting star, and a hanging man, would be a clear indication that the bulls have not yet given up control. The halfway point of larger bodied signals, the bearish engulfing signal, the dark cloud, or the bearish Hiromi, would be an indication that the bulls had not given up control yet either. As illustrated in the NABI chart, we had a nice uptrend in this stock until we got up close to the 50-day moving average, and our stochastics were starting to get up toward the overbought area. If this was going to be a short sale, what do we want to see over the next couple of days? Selling, confirming the doji at the top. We had the bearish engulfing signal, followed by a bullish Hiromi, which told us that probably the selling isn't going to be real extravagant. Where should we put our stop? Probably a close above any trading, a close above this level, the candle that indicated that the sellers are starting to take control. Upon a close up here, now we do not know whether this is going to go through the moving averages and continue higher. Why take that risk? Our stop should have been right here or closed out on that day. The following days indicate indecision at the 50-day moving average and selling. We can always reshort when the signals become clear confirmation. The IMAX chart also reveals a possibility of a good short sale. A strong bullish move up to the 50-day moving average, and what are we starting to see at this level? Saw a doji, another bullish day, another doji right at the 50-day moving average. What do we want to do if there's failure at this level? This would be a good place to start shorting. This could cause some concern, but notice it came up and touched the 200-day moving average and did not show any confirmation that there was new buying. What becomes the logical level that tells us that we should be out of this position if it comes back up through and the bulls are in control? Probably a close above the candle that told us that the bears were starting to take control after the day of indecision. For the next few days, it doesn't show anything that would reveal that the bulls are in control and that the bears are not in control. However, the day they take it up and close it above this level with stochastics turning up told us that we should have been stopped out at this level, which would have been an indication that the bears were not in control of this trend anymore. The bulls were in control. Additionally, not only does our stop loss keep us from being in a position that could go against us, using the candlestick analysis of our high profit patterns, we can now analyze that there might be a J-hook pattern forming. This allows the candlestick investor to make a new analysis that if we are now in an uptrend created with the stochastics coming up and the first attempt at the 50-day moving average failing, the 20-day moving average acting as support, and now the 50 and 200-day moving average not acting as a resistance anymore, the candlestick investor not only was stopped out of a losing short position, but could take advantage of the next high profit move due to the candlestick pattern, the J-hook pattern. A bearish engulfing signal with stochastics in the overbought area, followed by a run-up and another bearish engulfing signal. At some point, if you started shorting this stock, where becomes the logical point that tells us that the bulls are still in control? More than likely, if it came up and closed more than halfway up this bearish engulfing signal. When that occurs, that should be where you're stopped out, because this downtrend never got into effect. It was a slow uptrend, and we want to be out of that position as quickly as possible. As a downtrend is in progress from a short signal, in this case a bearish Hiromi, and the downtrend starts persisting, where becomes the logical spot that this downtrend wouldn't be in effect anymore? Probably trading above this last dark candle. Seeing any trading come up above that should have been stopped out of this trade, because that would have been a clear indication immediately that there was not any more pressure on the downside, and that could start an uptrend that you didn't want to be in. The same emotional problems for taking profits in a long position occur in short trades. You have an excellent profit by analyzing when to have shorted a position. It is now down in the levels that indicate it is time to take some profits. However, what do we hear on the investment news stations? The professional analysts reiterating how terrible the market is or how bad an industry is. There can't be any reason for wanting to buy these stocks. They have to be going lower. Use the same common sense analysis in taking profits on your long positions as you would on your short positions. At what levels would it indicate that the bears are losing control and the bulls are starting to take over? As demonstrated in the Bucyrus International Inc. chart, after a bearish engulfing signal, a downtrend starts. It comes down through a major moving average, the 50-day moving average, comes back up and tests it, and fails with another bearish engulfing signal. This makes two logical targets, that they're going to at least test the recent lows, or they're going to test the next major moving average. When it hits the potential target, this is where you start utilizing your stop losses. What should be occurring once it gets down to this level? That there might be some buying at the next major moving average. Pick out the spot that becomes the logical point that tells you the bulls are starting to step in to this trade. The same analysis can be seen in the MTW chart. A downtrend starts, comes down through the 50-day moving average, comes back up and tests it and fails. A failure of a moving average means two logical targets. They're going to test the recent lows or head for the next major moving average. Once it gets to that area, we now can utilize stops to protect our profits. We have a spinning top doji that just almost touched the 200-day moving average. Our stochastics are now in the oversold area. What do we want to use as a logical point that tells us the bulls might be taking control? Probably any trading above the previous day's high off the spinning top signal. That would provide evidence that the bulls are starting to step back into this trade. That is the logical point to start using our stops to protect profits. This brings us to the end of our candlestick analysis of stop losses. Now we'll do a quick review. The most important aspect that the Japanese rice traders provided for stop loss strategies is identifying the level that reveals that the current trend has been negated. The halfway point of a candle body is an important level. It reveals that the other camp still has control. Prices closing more than halfway down through the candlestick buy signal that revealed the possibility of a new uptrend occurring told the Japanese rice traders immediately that the bears were still in control. Entering a new trade, a close below the halfway point would indicate that the bears were still in control. However, it is not unusual to see the prices come back down through the halfway point during the day. This is usually the residue selling from the previous downtrend. A high percentage of the time, after the last of the residue selling is over, the prices come back toward the top of the trading range for the day. Then the uptrend will continue afterwards. If prices come down through the open price of a long body bullish signal, that gives clear indication that the bulls are still very much in control. A stop loss should be placed at the previous day's open for any trading during that day. As mentioned in the introduction, utilizing stop loss procedures in candlestick analysis does not require any extensive formulas. However, there is only one number that needs to be remembered when mastering the candlestick signals. That is the number 2. As illustrated in some of the 12 major signals, the hammer, the inverted hammer, the shooting star, and the hanging man, the tail or the shadow needs to be at least 2 times greater than the body. For stop loss purposes, a close below the halfway point of the previous candle that created the buy signal is a very important factor. The Japanese rice traders simply explain it as the sellers being able to knock the price more than halfway down the buy signal that illustrated that the buyers were in control, that if the sellers could knock it more than halfway down, they were still the majority of the strength. As can be seen in the 99-cent store chart, what could have been a good bullish signal was quickly negated by the fact that the following day they closed it more than halfway down the candle that confirmed the bullish Hiromi. Additionally, if the selling appears to have stalled at significant technical levels, and in this case the 20-day moving average, that lends more credence to the failure of the reversal. The moving averages that have major influences on prices are usually the 50-day moving average, the blue line, the 200-day moving average, the red line, and in some market conditions, the 20-day moving average, which is the light blue line. Witnessing bullish signals in an oversold condition just indicates that the probabilities are great that the trend may have reversed. However, no confirmation or a point that tells us that the bears are still in control confirms that the bulls are not in this trend. A bullish engulfing signal in an oversold condition without confirmation tells us the trend has not started. A bullish signal at the bottom of a trend, seeing a failure of the next day or a failure of a technical level, tells us that this chart has not turned positive yet. Apple Computer took a while to bottom out. Any point that looked like a buy signal that was not confirmed, or picking out a point that tells us the bears are still in control, tells you to be right back out of this trade. As of July, now there might be a point that tells us Apple Computer should be bought. Or on a small body signal, such as this bearish Hiromi at the top, the body may become less important, but the level that would indicate that the bearish signal had been negated becomes the logical stop loss area. The rationale being that a bearish Hiromi indicates that the buying had stopped. If the prices opened lower the next day, establishing a short position, and the prices could not stay down and moved up above that level, that would still be an indication that that signal did not work and you should be out of the position. Just as a bullish entry, a bearish entry needs to have confirmation. A doji at the top, starting to see sell candles. If you start shorting this stock, where becomes the logical spot that the bulls are in control? Probably halfway up this candle or halfway up this candle. The following 2 days shows new buying coming in. Want to be stopped out because this is not the downtrend that was anticipated. However, a few days later, you're right back into the trend with another bullish engulfing signal starting the downtrend. There is nothing wrong in any investing technique where if it doesn't look like you should be in the position and you can take a small loss, get out of the position, and if the position reconfirms or the signals reconfirm being back in that same direction, reestablish the trade. This is the cost of doing business and getting out of your positions as quickly as possible when they aren't confirming the direction of what the signals told you in the first place. This same process can be illustrated in the KOS Pharmaceuticals Inc. chart. Spinning top doji followed by a bearish candle, an evening star signal, turning stochastics back down. If you start shorting this stock in this area, where becomes the logical spot that you should not be in this position anymore? More than likely, more than halfway up the candle that told you the bears are starting to take control. Put your stop loss there, you're out of the position. Now you have a clear mind to say, all right, they didn't confirm the next day and they're starting to sell off. You can always reshort the position. But at this point, you do not know whether they're starting to take it back up. So why take that risk? Pick a point that tells you you should not be in that short position anymore. You can always come back into the trade later on. For taking profits, what becomes the logical spot that tells us the trend is over? If you can see important technical levels and see a candlestick sell signal potential forming, pick the spot that tells you that the bears are now in control of an uptrend or the bulls are in control of a downtrend. In this case, the halfway point of the previous bullish candle after a kind of a star trading day would have told us that a close below this level would have been a clear indication that the bears were now in control. It is time to take profits. That is where you want to sell your stop loss. Why do most investors hate using stop losses? Because they are convinced that whenever they put a stop loss in for protection, the market makers come right down to their stop loss and pick them off, and then immediately rally the price. Candlestick stop-loss procedures eliminate that fear. Using candlestick analysis, the stop losses are not placed at a percent pullback level. They are not placed at a level that an investor thinks they should be stopped out. They are placed at a level that when using the logic of candlestick signals, the price should not move back to that level if the uptrend or the downtrend is doing what it is supposed to. Candlestick stop losses are placed at common sense levels that illustrate very quickly that what a reversal or a trend was supposed to be doing is not doing it. This concludes our training on stop losses using candlestick signals. You can find further information about candlestick analysis on our website, www.candlestickforum.com. Please utilize the 400 pages of information on candlestick analysis to your advantage. As always, we offer our services to help investors learn how to use candlestick signals successfully. If you have any additional questions on how to utilize candlestick stop-loss procedures correctly, feel free to email us at any time. We will be glad to assist you in any way we can. Thank you for listening.